Tariffs are having a wide-ranging effect on sectors of the Canadian market, including real estate investment trusts. Joining us now to discuss whether REITs can weather this uncertainty, Sam Damiani, Managing Director with TD Cowen. And for a full disclosure on the companies covered by TD Cowen, a division of TD Securities, please see the link to the website at the end of this video. Sam, great to have you back on the program.
Thank you, Greg. Good to be back.
Uncertain times. I'm going to find a new word, but until I find that word, it is uncertain times. Yep. What has the tariff impact been on the REIT sector?
You know, it's been depending on the sector, it's been more meaningful, some more meaningful than others. But, you know, really over the last 3 years and ever since COVID, we've gone from crisis to uncertainty back to crisis. And this is just one more thing. So, you know, it's really, you know, quite a stretch of the REITs really trading well below their long-term averages. This is probably one of the longest stretches in memory. But for the tariffs specifically, we put out a note about a month ago ranking the real estate sectors in terms of the vulnerability to tariffs. And you know, most of the sectors are fairly immune, but the one sector that really stood out as being exposed would be the industrial warehouse sector, where you know, anything from logistics to the auto sector, obviously in southwestern Ontario, there's going to be, or there would be, if these tariffs hold, a real rejigging of supply chains and potentially some relocations of manufacturing. So it's caused a lot of uncertainty. There's that word again. And that uncertainty has really put a pause on many space users' decision making. So the leasing velocity we expect is slowing as we speak. You know, we'll see when the stats come out for Q1. But I think the leasing velocity is probably quite slow, and we're hearing anecdotal evidence from that from the REITs that we cover as well. So mostly the industrial REITs, and they've underperformed. They're the worst performing sector year to date, and the valuations are quite inexpensive too. When we look at the two larger cap industrial REITs, so that's Granite REIT and Dream Industrial, their multiples compared to the overall REIT sector are at their lowest levels on a relative basis in just about a decade. And interestingly as well, when we look at those multiples relative to their two smaller cap peers, that's a really, really tight variance to one that we've almost never seen. So just to put some numbers to it, the multiple variance between the larger cap industrial REITs and the smaller caps is about 10%. Historically, that's about a 50% variance. So in other words, that 50% premium's gone to a 10% premium, and it was as high as a double, you know, over the last 5 years. So this is a real compression in the valuations, absolutely and relatively for Granite and Dream Industrial. And again, it's all to do with, you know, that tariff threat, which really started last November and has really been picked up pace in the last few weeks.
Here's what some people call first-order effects, right? We can see the immediate consequences of, you know, trouble with global supply chains, what it means for industrials. What if, and this is a recession risk, right? And I think TD Economics has talked about this. If these, you know, tariffs persist, you could be into a mild recession in this country. If we started getting into that kind of situation, does it spread out for some of the other REITs?
You know, we look back, you know, some recessionary periods in the REIT space, and on average, the impact to occupancy is about 100 basis points on average, 1%. So it's not a huge impact. Most of the REITs are operating in fairly stable, you know, relatively stable real estate sectors or property types or geographies. So we don't expect a huge impact. Certainly the growth will slow. Maybe go negative briefly for some REITs in a recession scenario. But the bigger impact is on valuation. Like the stock market is forward thinking and likes to sell ahead of the news. And so we would argue that that's basically priced in at these levels. We've been hearing our clients talk about recession risk for some months now, especially our American clients looking at the Canadian market in general for REIT investing. You know, a lot of that money has gotten out of the Canadian REIT market over the last 6 months, ever since the immigration news was tabled last fall. That really put a crimp in the growth expectations, I would say, for some of the REITs that we cover, and has prompted some selling by some of our non-Canadian clients.
All right, with that money coming out of the Canadian REIT market, Canadian REITs trading at a discount to their U.S. peers. What kind of a discount are we talking about here?
We're talking pretty material discounts. You know, with that immigration news and the selling pressure that we saw as a result, the shopping center REITs, so you know, the RioCans, First Capitals of the world, for example, that group is trading at about a 30% discount to their U.S. counterparts that are basically operating in the same business, you know, grocery anchored shopping centers, for lack of a better word. And historically, that average discount is about half that, so about 15%. So that's a pretty big variance, and that 30% discount is basically historically unprecedented until recent months. Similarly, on the apartment side, we look at Canadian apartments versus US apartments. That discount on a multiple basis is about 12-13%, and historically they trade at par. So in both cases, we're looking at about a mid-teens above average relative discount for those two sectors, and the same can be said basically for industrial REITs as well.
Closer to home, not a tariff story, is of course the trouble that Hudson's Bay is in. Trying to restructure the business, a handful of stores look like it might survive all this. What impact does that have on the REIT sector?
Well, it really impacts two REITs in particular, RioCan and Primaris, and we've published that in our research over the last 3 weeks. But we look at the impact of the space that Hudson's Bay occupies. It's about 15 million square feet. So about the same that Target occupied, about the same that Sears Canada occupied. And those two had lasting impacts on the retail leasing market. In the case of Hudson's Bay, we really don't see an impact anywhere near to that extent, for the main reason that of that 15 million square feet, we think only about half of it is actually competitive space. Because a lot of that space is in these multi-story, high-rise downtown locations where the alternative use without a department store isn't retail. Like, there's no retailer that's going to take the 5th floor of the Queen Street Bay store. So you take that 14 million feet, take it down to maybe 7 million square feet of space that would become available, competitive on the market, that other retailers would consider leasing as an alternative perhaps to a new development or existing vacant space in another center. And so that 7 million feet is less than 1% of the total retail square footage in Canada. So really, it's certainly a bump in the road, but it's not a derailer or a long-term growth impact factor like we saw with Target and Sears. We think a lot of that space is actually going to be demolished because it's really not that attractive to start with. The second floor of a Bay store, for example, in a single-level mall, that's not very attractive. And so, not a huge impact. I think RioCan's got some things to work out, but that stock is down 10% since HBC filed CCAA, and we think that's overblown.
Okay, so we think about everything that's happening on the macro level and the specifics about Hudson's Bay. We put it all together. What fund flows? What are they looking like in the REIT space? Yeah,
they're not great. We just looked at the funds flows into money market, ETFs and mutual funds, and also GICs, term deposits. And a year ago, I think I was on this show, and we said one of the big sort of fund flows benefits, tailwinds that the REIT sector would expectedly benefit from is investors getting out of these 5% GICs and going back into yield-oriented equity sectors like REITs, like others, maybe utilities, telcos, what have you. And that was starting to happen last fall. And then with the volatility post-US election, we actually saw a sharp increase back into money market funds and ETFs and term deposits as well. So that is a clear sign that at the margin, the individual investor, is pulling money out of the equity market, certainly the yield-oriented sectors, and going back into those instruments. So negative at the margin today, and hopefully that's temporary.